Hello, and thanks for watching Mecardo's quarterly market insights update, brought to you by Nutrien Ag Solutions. My name's Olivia Agar, Manager of Business Development at Mecardo, and I'm bringing this update alongside Mecardo's Managing Director, Robert Herman. We'll go straight into cattle today, and it's really the commodity that's been the envy of all others through the pandemic. Quite possibly one of the few commodities, even outside of agriculture, to hit record prices at a time when the global demand picture has been so shaken up. And we're now at a point where our cattle are among the most expensive in the world. Of course, that record high price has all been a story of the local conditions here, with the rain continuing on the east coast and plenty of green paddocks seeing demand for young cattle surge and supply really tighten up. So we can see here that the young cattle indicators have held at those record levels for the better part of 6 months now. The most interesting part of the story, though, is that for the last 3 months, young cattle prices have been at a premium to the 90CL. So the 90CL is a lean trim of grinding beef that mostly gets exported to the US for hamburger mince. So we use that as a benchmark indicator for global beef prices. Now, our young cattle prices are usually at a discount to the 90CL price, so this is just one signal that the demand here is seeing our cattle markets really defy pressure from global beef markets and global prices. With the announcement of a La Nina weather event, though, it looks like these high prices will be sticking around for a while too. So the last 3 La Nina events have seen cattle prices reach record levels, with the stronger years like 2016 and 17 seeing the strongest price rises. So if we do see the expected rainfall over summer, and if history is anything to go off, we could very well see these strong store cattle prices hanging around until at least autumn. One of the other key trends of cattle markets in the recent quarter, though, is tight supply and lower exports. So Australian beef exports have progressively been falling over the most recent quarter, and that has been in line with shrinking production. It was over 13 years ago that Australia's beef export volumes were this low in September, which is pretty significant. But as much as lower production is a driver in that, demand from our key customers has also been weighed down both by those high cattle prices and also challenged by China's suspension of beef imports from a few of Australia's key processors. So we've been seeing Australia lose market share into some of our key international markets at the expense of countries like Mexico or New Zealand. So while tight supply is good for prices in the short term, it's not very good for our ability to service our export customers and maintain those relationships over the long term. We'll move on to an update on sheep meat now, and for that I'll pass over to Robert Herman.
Okay, thanks, Liv. Great to be able to talk about sheep meat, because in the last couple of years it's really been a shining light, but it also had a serious correction that came about and coincided with the COVID-19 impact. There are other factors in that. So COVID was certainly influencing demand. Prices were very high, but also we had the threat of processor interruptions, especially in Victoria, where the majority of sheep and lambs were processed. The other factors that, and we think that was an overcorrection. We think that happened. That was a little bit too much, and it's certainly proved to be the case as the market's recovered since. The other factor is that we're in a really terrific situation, certainly on the East Coast post-drought. So the new season's lambs are well advanced. While the matings were in the drought, and so there's not necessarily a lot more lambs about, they're certainly done very well, and their mothers have milked very well, so the lambs are well advanced and flowing through. And the other key factor probably in the sheep meat is the US has really been a strong component of a lamb price and developing a taste for lamb. So the Eastern States Trade Lamb Indicator and the Mutton Indicator are showing that while we've had a correction in recent times, we've seen the market spike back up again. It's interesting that this is coming at a time where traditionally we would see the market struggling under the weight of supply. but we're getting price volatility, but it's not the normal sort of price volatility as we would see in other years. And I guess that's the way the year is. The other thing that, and I mentioned about lambs being well advanced, the carcass weights are well up on last year and well up on the 5-year average. And of course, that's translating into increased revenues into our farmers' pockets, which is good. And I think it's also encouraging for lambs to come forward in a pretty orderly manner, coming forward fairly an orderly manner. That is, people aren't holding them back even though they've got feed. Those lambs are getting to good trade weights pretty quickly, and we can see on the charts in the report that the prediction is that while the lamb carcass weights won't hold at these levels, they will stay above the average and above last year's weights quite comfortably. The flow of lamb into the US is an interesting situation because we generally have two different types of key products that goes in there. We have the chilled rack, which is the high value product, and that's restaurant type meals. And you can see that it's been a really consistent price last year, but this year on the back of COVID and with restaurants being not able to operate at their normal capacity, that price has dropped away, although in recent times it's now recovering back up and heading back to where we would think it will settle down as COVID passes and industry gets back to full scale. The other one is the frozen leg, and the frozen leg is really a home-cooked product mainly, and you can see that the COVID has had very little impact on that, and it's remained very stable all the way through. So just staying on sheep, but moving on to wool. The wool market was one of the commodities that was really belted hard on as a result of COVID. We already had the market easing since the 2018 high. 2018, in the middle of the year, it peaked. It was easing, but there was no real concerns about any serious drop in the market until COVID hit, and that then belted it hard. It hit a 20-year low. In recent weeks, though, since the first week of September, we've actually seen an almost 30% lift or a 30% rally off the bottom of what looks like to be the bottom of the market now. And that was, so the 6 weeks since September have been very good. Supply is flowing at a manageable rate, so wool coming into the market is manageable. And one of the early impacts of COVID was that the demand had really been hit hard, firstly in the mills and then at retail level. And so the last thing you need in that situation is a flood of wool. So growers began to hold wool back. Now it seems like the market is flowing at a fairly manageable situation. The other note in our report was that the discounts for short wool or wool that's of poor staple strength or tender wool have really disappeared. And that tells us that the main demand is coming from the woolen section or the knitting section, not so much the worsted section, which is the spinning section. So that's just an anomaly or a different aspect of the market that's occurring at the moment. Tough times for wool. They've certainly, on the charts we're putting up, whether it's in the Western Market Indicator or the Eastern Market Indicator or in US dollars, doesn't matter. It's pretty tough times for wool, and coming off, what have been 3 very good years, very good seasons for wool growers, all but in terms of price, and although some had to suffer through the drought. The other thing that's changing, and I think this is a positive, is we're beginning to see the premiums for fine wool. And for a long time, the fine wool really suffered. And in droughts, it's a problem because we have excess volume of fine wool relative to the rest of the clip. And of course, that means that the premiums start to drop away. Now, as the droughts unfolded, as broken and the good seasons unfolded, we'll see that there's less fine wool in the clip, and the demand for that will mean that the premium for fine wool will grow. And you can see on that chart that we're heading back up to where we would see, coming off very low levels, around 100-cent premium for the 17 micron over 21s, to now be heading towards 600 cents, which is a really good sign. So moving off livestock and just having a quick look at grains and oilseeds. the market is very, very nervous. And the reason it's nervous is on the supply side. So even though we've got high stocks of wheat in the world, the volatility that COVID is causing, the actions of some countries who are trying to protect themselves against food inflation. China is hoovering up a lot of product around the world, and it's making the markets very nervous. And of course, that price volatility then gets extended when there's a week or two of dry periods, or we hear a report coming out of Russia that things aren't flowing quite so well, and so the markets are quite nervous, which is all playing into the positive for Australian producers. And while we've got this massive crop coming, which everybody knows about, we're seeing that our prices are trading at export parity. And of course, if in the rest of the world the market is going up, we're following along. And again, as with most commodities these days, China is driving demand. We know that in terms of barley, they got upset with Australia and decided to put a tariff on barley. That knocked us around for a little while, although we are seeing some recovery from that as barley finds other markets. But the demand for the big products in the grain and seeds world is soybean and corn, and then wheat, of course. And China is really hoovering up and buying stocks from everywhere. And not only are they driving the market, but other countries are getting nervous as well. We just recently heard that Egypt has made a big purchase of wheat at a time when their wheat crop's coming in. So they're looking at the future and trying to make sure they don't get caught short as well. So stocks of the world, global wheat production is running strongly. Stocks to use ratio is very high and comfortable, but at the same time we've got a lot of nervousness. If we look at Chicago prices, you can see in the last weeks and months we've just seen the market come off what looks to be like a bottom when we were going into the Northern Hemisphere harvest. The market seemed to have bottomed out because there was lots of stocks about and there weren't many concerns. But now that economies are starting to recover from COVID and people starting to make assumptions to what that might mean, they're now pushing prices upwards, and that's a strong move. The other thing we looked at in the quarterly report was the La Nina effect. Now, we know that generally La Nina is certainly a much more positive outlook for the seasons, and it certainly looks that way in Australia. 4 out of 6 of the last La Nina years have resulted in improved yields in production for Australian producers, and there's no doubt we will be looking back on this year as another strong year for production. And if it turns out that La Nina is consistent through the spring and into the summer, then we'll be attaching it to that as well. It's not the case for all countries, though, and all regions. We've got South America doesn't do well in a La Nina, and parts of Asia and into the Middle East and North America don't do well in a La Nina. And of course, we're looking at that in the context of what does that mean for Australian producers? Well, it may mean that at a time when we're having a good season, certainly on the East Coast, when we're having a good season, other countries mightn't be having such a good season, so that might put more pressure on supply and again keep prices quite strong. It's worth noting that it's generally accepted that La Nina is not a positive influence nor a negative influence for that matter. It's neutral for Western Australia, so it's mainly the East Coast that's looking to benefit from the La Nina event. So Liv, that's a brief summary of grains, sheep meats, wool and cattle, and I'll let you finish it off. Thank you.
Thanks, Rob, and thanks for watching this quarterly commodity market update. This was just a short snapshot of what's in the full quarterly report, so be sure to check out and read the reports which have more detailed information for your individual region. And if you'd like to tap into more of Mecardo's resources, you can subscribe to our market updates through the Mecardo website or listen to our weekly podcast, Commodity Conversations.